Howdy there, folks, and welcome into today's video. Hope you guys are doing great out there. As always, here today in this video, we're going to get into the public account. This is a stock market account I have that has over $1.6 million in it now. Started about 3 years and maybe like 9 months ago or something like that. We're coming up on the 4-year mark here in a few months from now, and we built it very successfully. And I kind of want to take you through the next moves I'm thinking about making in this account, and I'm also going to hopefully drop some gems in relation to how I think about portfolio diversification as I build up an account, those sorts of things. We're also going to take the account through performance-wise, calculated by Fidelity Investments, how the account is doing versus the stock market in general, things like that, so we can kind of judge, and like, how do I judge if I'm doing well in the market, bad in the market at a particular time, things like that. So I hope you guys enjoy this video. I hope you get a ton of information from it, a ton of knowledge from it in general. If you don't mind, smash that thumbs up button. That's literally all I ask for. That helps out huge in the YouTube algorithm, and I appreciate you guys for being here. Much love as always. Make sure you're subscribed if you're not subscribed and you want more content around stock videos, okay? So first up here, what we're looking at, we're looking at annualized return. Once again, this is calculated by Fidelity Investments, and we're looking at this account, the public account here, versus the market in general, okay? So in terms of the 1 month, we're outperforming quite a bit. As far as, versus S&P 500. A 3 month, we're basically in line. Year to date, we're doing slightly worse than S&P 500. 1 year, we're destroying it, and 3 year, we're destroying it as well, okay? Now, if in terms of how I always judge myself, I'm really looking at like at least 1 year out, but I'm really looking like 3 to 5 years. This account, since it's somewhat new still, it's only 3 years and 9 months or whatever, 8 months. The account doesn't have a long history yet. The longest we can go out is 3 years as of right now. I can't wait to see the 5-year returns versus S&P 500 and those sorts of things. We're getting basically an annualized return calculated by Fidelity Investments of 58.8% versus S&P 500 of 18.69% or 67%. The Dow Jones U.S. total stock market index is at 18.69, and then obviously the bond indexes. I mean, yeah, this is why I put in that work. Let's just put it that way. And don't believe you can't invest for yourself, you can't take your money in your own hands, you're not smart enough, all those sorts of things. If you got the right strategy and you're willing to put in the work, you can outperform the stock market. There's no doubt about it. I've seen it throughout my life, and I don't think I'm a rocket scientist or something like that. Okay, so that's annualized return. Cumulative return here, this one I like even more, 300+% cumulative return on a 3-year for the public account versus 67% for the S&P 500. This is what I expect. I expect to destroy the market. If I'm not, what am I putting in all that work for? Why am I listening to conference calls, reading annual reports, doing those sorts of things? There's got to be some monetary gain. I love it. It's a passion of mine, looking at companies, finding the next great stock that I think can 2x, 3x, 4x, 5x, right? But at the end of the day, it's got to add up to somebody, right? And this is why I love this, okay? So let's take a look now at the public account. I'm going to show you in detail. We're going to go through the positions, and I'm going to talk to you about kind of my next moves in the public account, how I'm thinking about portfolio diversification, and those sorts of things. Alrighty, folks, let's get into this, okay? So what we are looking at now is the public account in detail, okay? And I sort it by the biggest value of the stocks to the smallest value of the stocks, right? Smallest value is actually some cash. I got some cash laying around in the account, $842. Some of these stocks will pay out dividends, and sometimes the money I'll let it accumulate a little bit. Then I'll go ahead and invest that out into new stocks. The main, the stock account I actually get the most dividend money in is actually my main private account. And the reason that account I get the most dividend money is because that's the account I have like $1 million worth of Walgreens shares. If you don't know, Walgreens pays some big dividends. And so when you got like $1 million in Walgreens stock, and they pay out all the dividend money, it's going to add up to a big number. So I make more dividend money in that particular account plus other positions than the public account and the dividends only account, which both the dividends only account, the public account, and the options only account, that's available for everybody in my private stock group to see every single move I ever make in this particular account. Every single move I've ever made in the public account has been documented, and those sorts of things, okay? So Tesla shares right off the bat here, obviously doing tremendous on this. This makes up a good portion of the account, right? We're talking $491,000 out of a $1.6 million account, right? Now, for some folks, that might be too heavy, right? To have in one position. That's a good chunk, right? If we were to break this down, we say, well, if we had 50% of the money in one stock, that would be roughly $800,000 plus dollars, right? So we're at, I don't know, maybe that's 25 to 30% of the account balance is essentially in Tesla shares. I feel comfortable with that for two reasons. One, I love Tesla, the company, huge believer in it as far as EVs, as far as autonomous driving, the numbers I see out of this company, the brand they've been able to build over the past few years and go from, what was very, very niche automaker essentially a few years ago to now this is all of a sudden the threat to the entire automobile industry nowadays. It's absolutely amazing like how fast things have turned there for Tesla, right? And so I'm a huge believer in the company. The company's autonomous driving. I think they have a great chance at being the premier player when it comes to autonomous taxi networks, those sorts of things, right? And so I look at this stock. I love it, one, right? But two, the second reason why I feel comfortable holding, let's say 30% of the money, of the account money in Tesla shares is it's not like I put in a crazy amount to the stock, right? The cost base is rather low, $34,000. Whenever I'm thinking, and this is a kind of a gem for portfolio diversification, whenever I'm thinking about how diversified I am for a portfolio, I'm thinking about what I'm putting into that position, right? So if I put, let's say, I don't know, I was to deposit $1 million in this account and buy $1 million worth of stock, that would be an extremely aggressive move. Probably too aggressive for even somebody like myself, right? But when I put in $34,000, it's gone up a lot, right? The gain on that is 1,339%. So in terms of this position sizing, I feel comfortable with it, although it definitely is quite a bit. It's over 2x my next closest position, right, which is Tattooed Chef at about 200,000. Now, I think Tattooed Chef is going to go on a run over the next several years, okay? And essentially, as the company produces bigger and bigger numbers, I think the stock price will increase. Eventually, I truly believe that Tattooed Chef will become a bigger position in this account than Tesla over time, okay? Now, right off the bat, I got to think about, okay, what are my two biggest positions, my big dogs, right? We're talking, this is nearly $700,000 out of a $1.6 million account is in these two stocks, right? We got EVs plus energy plus autonomous driving, right? And then we have a extremely fast growth company in the vegan space, vegetarian space, whatever you want to call it, right? And they're producing into a lot more products over time, right? And so I look at this and I say it's two diversified companies, right? And then I go down to my third position here, Revolve, right? 162,000. We're talking about a clothing company, an apparel company, right? And average ticket size sometimes for Revolve is pushing up toward $300, right? But you can see where we've got diversified positions here across our biggest positions. If we move down the next one, and I'm going to come back to these and talk about these a little bit here. I just want to point this out, right? Next biggest position down there, 152,000, Dropbox, right? Cloud company, e-signing of documents. And the next biggest down there is 151,000 in a gaming company, streaming company. So if you're looking at the portfolio, you're seeing a lot of different stocks in different sectors, different industries. It's not like these are all stocks doing the same exact thing, right? And let's just finish out all the way down here to the other positions that are 100,000+, right? You got Facebook here at $128,000 in that one, right? Biggest social media giant in the world. How do they make most of their money? Advertising revenue, okay? And Skyworks Solutions, which is a semiconductor company that's just, expanding their business massively right now in the 5G space, right? And so when I look at the overall, like what's really running in the account, the six-figure positions are what is running this account, right? Out of a $1.6 million+ account, it's all about the six-figure positions. This is what's going to be what, takes us to the moon, as they say, or takes us down, right? And so when I look at this, I'm seeing great diversification in tons of different industries. None of these really overlap at all. You can't really find anything that overlaps in any of these companies, and I love that, okay? Now let's take it back up to Tattooed Chef here, right? Tattooed Chef, I can see building this position a little bigger in this account. I could see maybe building the position out to $250,000 and then letting it run from there essentially, okay? Now, like I said, regardless, I think Tattooed Chef long-term will overtake Tesla in terms of the biggest value in the account, especially if I get it up to $250,000. And then, based upon the run, I think this stock's going to go on over the coming years. I think Tattoo Chef over time will overtake Tesla as far as the biggest position in the portfolio. I think it's just going to take a few years to do that. I don't think it's happening tomorrow. I don't think it's happening next week or something like that, or even next month, okay? I think it's going to take several years, but over years, Tattoo Chef will outperform Tesla and end up becoming the biggest position. Tesla's already had a huge, massive run over the last couple of years, and that's pulled a lot of gains from future years, in my opinion. Tattoo Chef hasn't even gone on a run yet. Just wait till that one goes on a run, and then another run, and then another run, okay? As far as Revolve, this is a stock I'm not interested in buying any more of. With the gains we've gotten are great in the stock, 475%. I'm very, very comfortable with the position overall. I'm not interested in selling it. I've always looked at this company as being on the new frontier of really expanding their apparel business, e-commerce, and maybe being much more profitable than a lot of the old school department stores are. And the way I always looked at this one is I said, well, the old school department stores, when they were in their primes, those companies had market capitalizations of tens of billions of dollars, right? And I look at something like a Revolve, I think this company has the potential to do that sort of business. But the better thing is, I think the e-commerce side's actually going to be a lot more profitable than the department stores. The department stores always had crazy overhead, right? You have to have the employees all there right in the store, right? But not just that, the huge rents that the malls would charge back in the day were substantial. And so when you think about it from that context versus just you're running warehouses, it's a lot more cost effective. Also, the department stores always had to be in this business model of the sales. And whoever had the bigger sign with the bigger sales, 70% off, right, might have got more customers in their store. And so Macy's and JCPenney's and Dillard's and Nordstrom and all these, the bigger the sale, the better, right? And so I've always looked at a Revolve as being that company that I think they're going to be much more profitable long term than actually any of those old school department stores were. E-commerce, okay? Dropbox. There's a position that also I feel very comfortable with. I would not be against adding, let's say, another 555 shares to this portfolio or something like that of Dropbox and bring it up to maybe 5,555 shares. But I am comfortable with the position sizing here. The stock's already gone on a decent run. I think it's got a lot more ahead of it in the future years. But it's already made its real, initial run here, right? 57% gain, 55,000. I remember when I first started talking about this stock, there was a lot of him and Han, it's not super high growth, blah, blah, blah. And the way I always looked at this is just a solid growth company with a super attractive valuation, with an extremely sticky business model, with near no customer concentration. With a great balance sheet. What is there not to like in a stock like this? Yeah, it doesn't have the 30% revenue growth or 40% revenue growth or 50% revenue growth that some of the big techs. But you know what else it doesn't have? A massive valuation behind it. It had an extremely attractive forward P on the stock. And I said, with the type of growth I think this company's still going to have in future years, that's willing for me to take a risk. It's obviously paying off very well. I'm comfortable with the position sizing, but I wouldn't mind adding more of these shares. So it's a little different than Revolve. Revolve, I'm not interested in buying any more shares at all. Dropbox, I'm like, I can see myself not adding any more shares, but if I added a little more, it would be cool too, okay? But yeah, that one's Dropbox there, okay? Corsair Gaming. And this is a stock in which I can definitely see myself adding more shares of. I could see myself getting all the way up to potentially 7,000 shares of Corsair Gaming in the public count. I do not mind building this one bigger. They were talking leading in the gaming space, the streaming space, right? And a super attractive forward P, great management team on this company, and a company that just continues to buy out other innovative growth companies and help grow those businesses as well, right? And so they got a lot of business lines now that are outside of just Corsair Gaming. So when I look at Corsair and I look at being down almost 15% on the stock, I look at a stock that I'm saying, let me get my cost basis down more on. Let's get down to a $33 cost basis, maybe a $33, something like that. That would be very, very attractive for me. So yes, I'm definitely interested in continuing to add this position. My hope is it goes back under $30 a share. If it does, I'll add more shares of stock, maybe get it up to 7,000 shares. That would be about my max in this account. I can't see myself owning more than 7,000 shares in this particular account. That would be about my max for how big I would want to make a position like that, with where the account size is for the public account right now, okay? Facebook. 371 shares of Facebook. I should have bought this one stronger. This one was one of the initial positions I built in the account, okay? This account in the early days was actually built off of 4 main stocks: Facebook, Skyworks Solutions, Cruisy Doozy, and Tesla Maesla. Okay, those were the 4 stocks that were really the first bunch. Then Elf Beauty came on, and we made a ton of money from Elf Beauty, took a ton of profits, and we took a ton of profits from Cruisy Doozy over time. And we'll get to those in just a moment. And so those positions look much smaller now, but they at one time were much bigger positions. We just made a ton of money on them, and we took some dang profits. Okay, and deployed that into some other positions. But that's where the account was built on. And I look at this as something like Facebook, and I always feel like I should build this position bigger. It's the, let's see, 1, 2, 3, 4, 5, 6. It's the 6th biggest position in the portfolio and arguably the safest position in the portfolio. I feel like it should be top 5 for sure, if not top 3. So I honestly look at it, and yes, we are up massively on it. We're up 125%, up $71,000 in this position. But I honestly look at it, and I look at its valuation, and I honestly still feel like I should buy more shares, all right? Now, the one thing I am worried about is big tech has been moving up and moving up. And a lot of the valuations on big tech have gotten pushed. I don't really feel like Facebook's as much, but a lot of those big techs have been pushed and pushed and pushed, okay? And so I do worry a little bit that maybe there would be some short-term weakness, and maybe, Facebook will come down a little bit. But at the end of the day, I look at this and I say, I think the fall for Facebook would be way less dramatic than anything else, or a period of stagnation. And I wouldn't mind it. I know if this stock downtrended for a little bit or had any stagnation, I would just look at that as an opportunity for me to build this position bigger in the portfolio, because the risk reward is as attractive in that stock as you can pretty much find. I almost feel like I don't want to say there's no risk in it, because every stock has risk, but it's one of the least risky ones I can find out there, especially based upon current valuations. Skyworks Solutions. I spoke about this one just a bit ago, right? Skyworks Solutions, the business is amazing, okay? Semiconductor company, extremely profitable, always innovating on the next big thing, and their next big thing has been 5G. 5G devices have just really started to take off in the past 12 months, right? And so imagine where 5G devices are going to be in another 12 months from now, 24 months from now. Everything's going to be expected to be 5G. Doesn't matter what it is. And the most direct beneficiary of that is likely Skyworks Solutions, because they are making a ton of the 5G chips. Look at the 5G iPhones and look at the chipsets and count how many Skyworks Solutions chips are. It's absolutely amazing. You almost need 2 hands to count all the dang chips that Skyworks has in the latest iPhone generations. It's going to likely be like that for years and years to go in the future, and they got a whole lot more than just Apple as their customer. They do great business in the Android space as well as other devices and things like that. So Skyworks Solutions, I'm comfortable with the position sizing. I love the stock. I have no interest in selling the stock. If it went to 250, maybe. If it went to 250, maybe I would consider it. But the thing that keeps me in Skyworks Solution is the management team at the company is so amazing. The 5G boom is going to be a multi-year boom, right? The profitability for the business model is amazing. It's a great dividend stock, and the company's always pushing for the next innovative thing. So something's going to come after 5G, and guess who's likely going to be a huge player in that as well? Skyworks Solutions. And they buy other companies that help them grow their business and their EPS and their revenue as well. So that's what keeps me around for Skyworks. And, I have no interest in necessarily buying more shares in this account, but I also have no interest in selling the shares. I'm comfortable with what I have, okay? Now we're getting into some of the smaller positions, okay? Some of the smaller positions get interesting because I feel like a lot of times with the smaller positions, that's where I start to look and I say, maybe it's worth me selling a stock. Maybe it's worth me adding a new stock to this. And by the way, we'll speak about if I'm thinking about adding some new stocks to this portfolio as well in this video, okay? So Planet 13, Planet 13, this is a tough one for me. So $61,000 is the position sizing in this account, okay? I've bought Planet and averaged up in the main private account and other accounts, but I've never done it in this account. And I don't know why. Maybe it's the $1.25. Like sometimes I think there's got to be like subconscious reasons sometimes on why you're doing certain things or not doing certain things in life. And so I'm like, I've bought Planet in all the other accounts. I've averaged up in the position, but I've refused to do it in this account. Why is it? I honestly think subconsciously that $1.25 cost basis is preventing me from buying more shares in this account when it would be a very wise decision for me to have been averaging up on this position in this account as well. But I think that $1.25 cost basis, I look at that and it makes me feel good. And I think I see it and I'm like, oh, do I really want to make it a $2 cost basis now or $2.25? It's a bad decision to ever make a decision based upon what looks good. At the end of the day, what's going to make me money? The fact is, I've averaged up on Planet and other accounts. It's been a phenomenal decision because I believe in the company a lot. I've looked at this one, and even as it was climbing to a $300 million market cap, $500 million market cap, $700 million market cap, I looked at this company and I said, this is a potential $5 billion, $10 billion company down the road. For me to make a decision not to buy at 300 mil, 500 mil, 700 mil as a billion plus now, if I think it's going to 5 to 10 bill, it makes a lot of dang sense. So sometimes you guys got to watch out for these subconscious things your mind does, where you got a situation like this and you look and you're like, that stock's a great deal, but man, that cost basis looks so dang good, right? I think subconsciously that's ended up hurting me in this one. I should have built the position bigger. Okay. Upwork. This is one I'm actually not interested in buying more shares of. It's up huge for us. We're up 311%. I do look at this one and I have a lot of regrets that I didn't buy heavier. Not because it's already gone up so much and we made so much dang money on it, but really I have a lot of regrets because I love the company. I love what they were doing. The valuation was silly. And I went to weak sauce. And right after I started investing in this one, it made an initial big upward move of like 10, 20% really, really quick. And that's another mistake I made there where I was like, well, maybe it'll fall back down. Maybe it'll chill out. It never did. And it just kept climbing and climbing and climbing and climbing. When really, what I should have been doing is it was still a disgusting value. When I started buying the stock, $13.43 cost base on this one. When it went to 15, who cares? I still thought this was a stock that's going, $30 or $40 plus over the coming years. Why not build it bigger, right? So another one of those things that sometimes is a problem in the stock market where you look at a stock and you're like, this stock's a 2x, 3x, 4x potential, but it goes up its first 10, 20%, and all of a sudden you're like, nah, I won't buy it anymore. Does that make any sense? No, it doesn't, okay? So Upwork, I definitely regret not building that position bigger. As far as like I said, I'm not interested in buying any more nowadays. To be quite honest, I feel like it's just a hold, $45,000. I'm comfortable, okay? Avant Brands, so this used to be GGTTF. They changed their ticker symbol, the G-Tech company. I like that they changed their ticker symbol, by the way. I never liked that one. It got confused with another G-Tech. It was kind of a mess. But this Avant Brands, AVTBF, the numbers they've been reporting are phenomenal. They're in the Jack Jackson space, competing at the higher end. And this is a position that I feel like I could build a little bigger. Now, I can't build this position massively bigger. Maybe I get up to like 88,888 shares or something like that. I can't build this position massively bigger. Why? It comes with risk. It absolutely comes with a lot more risk than a lot of these stocks, right? It's a super small cap. We're talking, it's been trading roughly anywhere around $100 million market cap. That's by far and away the smallest stock I hold in any of my portfolios. There's no other stock that is even close to that small of a company, okay? When you got that small of a company, it's going to come with risks, right? It's somewhat of a newer company, still only been around for a few years. Norton, the CEO over there, he looks like he's got his head on straight. He looks like he's got the business very focused on growth and growth and growth. And I'm a big believer in it. And I think it is a potential billion-dollar-plus company down the road. But they've got a lot of work to do to get to that sort of level, right? And so I look at this one and I say, I could see myself building it bigger, but not like, let me double up my position sizing or something like that, because it absolutely is. I always think about risk reward when it comes to all these stocks, and this one absolutely, without a doubt, comes with, definitely risk involved here, okay? But that reward potential is going to get me every time, right? Walgreens Boots Alliance, WBA. I'm comfortable with position sizing in this particular account. The reason being is I already got $1 million plus of this stock in my main private account. So I'm not necessarily in the market to be a huge buyer of Walgreens. What I am potentially interested in when it comes to Walgreens, and this doesn't pertain to this particular account, it would be more for my options only account, right? But what I'm looking at is potentially buying 2024 call options in Walgreens whenever they come out, which is in September essentially. And I'll be looking at $40 strikes and $45 strikes mainly, and maybe even $50 strikes if the risk reward's there. And I'll be looking at that. That's what I'm really considering with Walgreens. The share size, I'm perfectly fine in this account, okay? Elf on a Shelf. This is a company, so part of me regrets selling a lot of shares. I sold a lot of shares after it made me the initial huge gain on that stock. And I kind of regret selling them to a certain extent, but I bought a lot of stocks that ended up making us a lot of money as well in this account. So, it's kind of like, well, you sold out, but you invested in a lot of stocks that made money. So was it really a bad thing, right? But when it comes to Elf Beauty, I've always looked at this as like, a small cosmetics company that has a phenomenal brand. They got a phenomenal team there. They've been building out the business very successful. And so, yeah, I love the diversification it adds to the portfolio. So right now it's in no man's land, and the same exact thing with Cruisy Doozy. Cruisy Doozy is a stock we took a ton of profits on over the past few years, and it's kind of in no man's land right now. I like Cruisy Doozy. I like they just made a very, very interesting acquisition, and I'm definitely considering, keyword is considering, adding some more Cruisy Doozy. There's a lot of talk that there could be new chips in the next generation of iPhone that will add substantially to Cruise's business model. And they just made a very interesting $300 million plus buyout of another company, which gives them an opportunity to expand more chips into the iPhones. So, but with Cruisy Doozy, arguably the riskiest stock in the portfolio outside of maybe Avant Brands. Here's why. Cruisy Doozy gets roughly 80% of their revenue from Apple, one company. So if their relationship ever broke, which I don't think their relationship will break, but if their relationship ever broke with Apple, it would be absolutely extremely detrimental to the stock. I mean, if there was ever some announcement that Cruise was like, oh yeah, Apple's going their own way, we're going to start splitting. I mean, the stock's down 50% the next day. It would be disaster zone. My hope is that never happens. The company's always been so well run. They produce great chips for Apple. It doesn't make sense for Apple to get rid of Cruisy Doozy, okay? And so let's talk for a moment about any potential acquisitions I could have in this portfolio. So first off, we're in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 different stocks here. I can definitely see myself adding at least one more stock to this portfolio, if not 2 more stocks to this portfolio, okay? One stock that comes to mind that I've always, man, this is a tough stock for me to talk about because I've always thought about buying it. I've never done it, ever, which is amazing. Amazon. I've always felt like Amazon deserves to be in the public count. Amazon's a beast business model. I don't know when Amazon starts to not grow their business. I can't even see it. It's so far in the future that I don't even know when Amazon isn't growing at 10% plus clip. Never mind not growing the business in general. It's so many years away. So I've always felt like Amazon deserves to be in this portfolio somewhere. And that's just, it's just a tough one for me. I mean, when you think about Amazon, you're thinking about not just the e-commerce side, but Amazon Web Services, which is absolutely a must for countless companies out there, right? You think about Whole Foods, you think about Zappos, you think about they own Twitch. You got to understand, when you're buying Amazon, you're buying a ton of extremely successful, huge companies. You're not just buying Amazon, the e-commerce operation, right? And they just continue to expand the business around the world. It's absolutely amazing what they've been able to do. And so I've always felt like Amazon belongs in this account. And the last stock I've always felt like belongs in this account is Google McDougal. You're getting Google Search, the premier search engine in the world, right? You're getting YouTube, you're getting the Google Cloud, you're getting Android, you're getting all these amazing, amazing things. And so I've always felt like Google also, belongs in this dang portfolio somewhere. And so those are 2 stocks I always just have to consider in adding this account to get a couple more bigger positions kind of built here, guys. So hope you enjoyed this as always. Let me know what you think about this portfolio. Do you like it? Do you not like it? I would love to hear from you guys in that comment section as always. Do you own any of these stocks in your portfolio? I would love to hear from you guys as always down there. If you're looking to learn more about my private stock group, the private Discord chat, all those sorts of things, check out the video. It's going to be the pinned comment on this video, and enjoy that. It's going to be a little 7-minute video. It's going to go through everything in the private group, and then if you want to join there, it'd be a little basically button to click under there if you're looking to join in there. Much love as always, and have a great